This is our class for December 8th, 2011, and I'm doing this on narrow range patterns. Narrow range patterns are when the volatility over the previous period, the previous bar, is less than a few bars before. There's NR 4 bars, which mean the previous bar's high minus low was less than the previous 4 bars, and that bar also fit inside the previous bar. In other words, the high is less than the previous high, low's greater than the previous low is greater than the previous low. It pretty much sits inside the previous bar. And there's also NR 7 bars, which means the previous bar moved less than the previous 7 bars. Now, for our software, the main one I use is the 4-hour narrow range pattern, which you can easily set up on your chart by going to Add Script, finding the pattern called NR Breakout, and putting 240 minutes in here. And you probably don't want to have, you can get rid of all this trailing stop stuff if you don't want to show the trailing stop after it. But it basically will monitor, it only works live, and as a period is over, after a 4-hour bar is over, if that 4-hour bar moved less than the previous 4 bars and it's inside the previous bar, then it's going to show lines on here. And if the previous 4-hour bar was smaller than the previous 7 bars, which, 7 times 4 is 28 hours. It's more than the previous day. That's extreme low volatility. You can see the high of the previous 4-hour bars up here and the low right here. And anytime you get an asterisk after it, it also means that that is an NR7 inside bar, which means not only was it tiny, but it didn't break out of the previous 4-hour bar, which you can actually see on this chart here, because this, and sometimes, like you can see on this bar, you have 2 narrow range patterns in a row. I call this a double narrow range pattern, and it usually, probably 60 to 80% of the time leads to big trends. But sometimes you have, like you can see here, false breakouts, you would have had a loss, false breakout, loss. And then when it reversed the other way, you have an absolutely huge trend, which after the pullback continued again. And basically, the rules of using this narrow range pattern, and for those who want to trade a system that has as high a winning percentage as possible, narrow range patterns have about a 50 to 55% winning rate, in some days 30 to 35%. However, even when the trades don't work, you can use them to your advantage and to make money later in the day, because once you see these narrow range patterns and the market breaks out of it, usually those trends continue. As you can see, down, nice little pullback right here, which probably is to a Fibonacci area. Look, it went right to the 50% Fibonacci area, and then it continued down to the Fibonacci profit target. And like I frequently say in class, the 1.618, 70-80% of the time is the maximum profit you're going to get. Get out of that trade. As you can see, it shot back up 50 pips, so don't be greedy. So you had, from this narrow range pattern, a breakout here where you would have lost 6 to 12 pips. Breakout here, you lost 5 or 6 pips. And then when it failed, and you can see, first of all, that the weekly and monthly trend's down, so a breakout to the upside is less likely to work. It's much more likely to trend in the direction of the longer-term weekly and monthly trend, which is down. And also, the first time it broke out here, there really wasn't that much momentum. You might have really wanted to wait for it to go above this previous narrow range pattern, which is up here. So, experienced traders might have got in here, but after losing 6 to 10 pips, they would have waited for it to go above here, and they wouldn't have had a second loss. And then when it went down here, nice little 20 or 30 pip profit. Short right here, you would have lost 6 or 7 or 10 pips. Short again right here, and you made 60 pips. So again, a system in a method of trading is profitable over a series of trades. Any individual trade, if you only took this trade right here and got stopped out, you would have a loss for the day. If you took, the trade right here, the only trade for the day, you would have had a loss. If you took that trade, went short, you got that loss back plus profit, shorted here, you have a loss, you're 50-50 on the day, but you're maybe up 10 to 15 pips. Then you short here and you got a big 50 pip win. You have a nice 60 pip day. And by the way, 10 pips per day will double your account every 2 months if you use small risk per trade. And so a 60 pip win for the day is an entire week's worth of profit plus 1 day. So that's very important to realize. Let's look for some other narrow range patterns to go over this as well. Here is the euro dollar, and you can see also two narrow range patterns when it broke out right here. This is a good example because you actually would have made a little bit on this or broke even. The price kind of went up a little bit. Again, the weekly monthly trend's down, but this one broke out with a lot more momentum. But once the market goes sideways for 30 minutes or an hour, you really want to move your stop to break even and really consider getting out of this. When this broke out right here at 13, it did go all the way up to 32, so it went up 17 pips. Most people probably would have made 5 to 12 pips on a half, moved their stop to break even, kind of waited for it to break out. And when it didn't, and again, the weekly monthly trend's down, you can use this to trade later in the day. Here's a very significant low. We have a narrow range pattern followed by another one. This narrow range pattern is smaller than this, and you can see it's inside the previous range because the low is greater than the previous bar's low, the high is less than the previous bar's high. And so when it broke down here, it's very likely to trend down. And so I probably would have sold right here. And unfortunately, it went down and found major support right here. And once you're in a trade and it barely goes your way, and it starts going down and it has less weakness than it had before, common sense tells you to probably exit at least half your trade here when it goes sideways at 81. You might have made 6 pips on the first half. I would have probably moved my stop down here for break even on the other half. And so that trade we only, would have made, 3 or 4 net pips. And then it explodes up again. Previously it had some strength. It broke from underneath above the hourly with a lot of momentum. And you buy this pullback right here. Because narrow range patterns tend to lead to big trends. It didn't here, but this time it did. It went up about 75 pips. So you don't always catch the first wave, but you do take this pullback trade and you want to get out at the fib targets. Remember what I always say, the 1.618 most of the time is your maximum profit. It also happens to be one of the trading zone's fib areas that I do each night. I spend about 30-40 minutes each night drawing fibs. They show up on your chart. That nailed the high today, my Fibonacci profit target. Nailed the low, found support, and it was absolute low so far. So you don't have to spend 30 or 40 minutes analyzing each currency each night because I do it for you. But this trade right here, you're in at 13. You're probably going to exit the whole thing up here because, again, 80% of the time, the 1.618 your maximum profit, you made about 35 pips on it. Now, this is obviously a news-related thing, but the whole concept of narrow range patterns leading to trends, it failed. Both of these instances, you made a little bit of money or broke even. Then you made, a decent amount of pips on that one. And you can use the range chart. And when this thing is falling, you can't always find an entry on a 5-minute chart, but usually you can on the range chart. Here's the 6 pips per bar chart. Again, we're expecting trends, and when it breaks down here with a lot of weakness, finds support at the hourly, isn't able to get a bounce off of it, you can go short here on a range chart for quick little scalps. You're in this trade here at 94, and I would have probably got out at 65 here. It also goes sideways again. If you want to take a very small risk trade a little bit smaller lots than you did normally on that second one. And the whole thing is, when you find narrow range patterns, they're more likely to trend. So you can take trades like this where most times you wouldn't want to. Once the currency's fallen a lot, it becomes riskier to do so. But because there was a narrow range pattern earlier, you can do so today. You're short at 33.57, and again, you're not expecting these fib targets to get broken. You're out somewhere around here. But you made about 25, 30 pips on that trade that you might not have taken if you hadn't had that narrow range pattern. Now here's narrow range patterns last night. Most people don't trade until about 3 a.m. until noon. Narrow range pattern. The weekly trend is up. The monthly trend's pretty weak. When it broke underneath here, you had a small profit, and then you can see it trended down the rest of the day. But basically, narrow range patterns tend to find trends, and they also increase your odds, again, like I said, with the euro pairs, when the weekly and monthly trend is in that direction. I prefer the weekly over the monthly. I don't care what the monthly is. But breakouts underneath the lows, if it's also underneath the hourly, it's much more likely to work. You don't want to sell a breakdown underneath the low of a narrow range pattern if it's above the hourly, because it's not likely to work. Sell the lows when the price is also underneath the hourly. Buy the breakouts of the high when price is above the hourly's high. So in other words, you would want to buy this. And this is one of those instances where the narrow range pattern happened right near the hourly. So if it broke out above, it would be okay to buy. If it breaks out below, it'd be okay to sell. This one, it's only okay to buy. It's not okay to sell because it's way above the hourly. It's much more likely to break out to the upside. You don't want to have an unnecessary loss. Usually if it does break out at the low, it'll find support here and kind of go up. And then if it breaks underneath the hourly again, you can take the trade and catch the second wave down. But once these narrow range patterns happen, and especially when a resistance area is what caused it, this price was stuck between my Fibonacci area up here, which is a likely high, and the hourly, which has major buying at usually. And once it breaks underneath there, it continues. This is also a very excellent example of a retest. A support level once broken becomes resistance. So you got a beautiful trade right here, confirmed by the narrow range pattern as well. It's much more likely to go to the fib targets, and so you'd be out of the trade here at 61, short at maybe 88 for a 25 pip win. You shorted it again right here, made money, and once it goes to the lower band, usually you want to wait for an Elliott two-wave pullback. You have one right here, right to that area. You go short, and at that point, your Fibonacci profit target of the whole move gives you your exit down here. And guess what? The 1.618 was pretty much within 3 or 4 pips the maximum low there. Here's some narrow range patterns on this one. This price is underneath the hourly, so you prefer to sell it. You short here, you have about 10-15 pip profit. Comes back up to the hourly in a major resistance area. It's not able to go above the high of that narrow range pattern. You go short again, you made money. And on the way up, it shot way above here, and there's not really much of a pullback, so you're done for the day in this one. 2 narrow range patterns. Price is right near the hourly. A lot of times these do happen when it's near the hourly, and it goes underneath the low here, and you would have had a loss. You can see it really didn't have that much momentum to the downside. The last thrust was up. This one, the dollar didn't go up too much against the CAD, mainly because probably the CAD was also relatively strong too, but against other pairs, the dollar was very strong at the time, and that's what this shows you. And so, if you had a small loss right here, you shorted this as well, you have about a 30 pip win here. And once it breaks back up above the hourly, narrow range patterns tend to lead the trends, and when they don't, or the price reverses back past this, these are very key zones. When it breaks above here, it's very likely to have a strong trend up, and it did. It went up over 100 pips. So this is another great example of how to use this. It's either going to make you a lot of money on trend moves, or you're going to get chopped up a little bit, but later in the day, catch a big move out of it. That's what typically happens. 2 narrow range patterns. This trend breakout worked. You have a pullback. It worked as well. And I have fib areas on there from yesterday. Narrow range pattern, broke out, again, continue. Narrow range pattern, breakout, failed, and it finally broke out of here. It went from 18 all the way up to 79. Big trend. And, again, when it failed up here and came down and broke underneath this low here, it becomes very significant. You can start aggressively selling it underneath there, and it fell about 75 pips. So the whole point of this pattern is it doesn't have the highest winning rate of all of our systems. It's probably one of the lowest, but it does oftentimes find trends. And when trends don't develop on the first move, if the trend goes the opposite way, it's likely to trend extremely strong.